Do you remember the days when bank CDs were paying you 3, 4, and even 5%? Well, they're back. Well, they're kind of back. Let me explain. Recent article we found here in CNBC by Todd Buchholz. He told a true story of his own mother getting, not swindled, but trying to get convinced to buying this 4% CD from a bank. FDIC insured, the whole kit and caboodle. And now a lot of you are probably scratching your head saying, well, wait a minute. Bank CDs are not paying 4%. What's the catch, right? And usually anytime that something's too good to be true, it normally is. And here's what's happening. Financial professionals out there, financial advisors, insurance agents, are basically teaming up with certain banks out there, and the banks might only be paying, let's just say, 1%. And so the bank really is going to give 1% on your, let's just say, $10,000 bank CD, and they have to honor that. And over a 6-month period, of course, that would be $50. Well, what the financial advisor is doing is they're taking money out of their own pocket, and they're gonna basically cover the rest. That part, of course, is not FDIC insured. It's really going to be kind of backed by them. So what's happening is the bank is really only given the same rate of return they're going to give to anyone who walks in the front door. The rest is coming out of the financial advisor's pocket. Now, is this legal? I believe it is. We can't find anything to say it's not legal. I know some financial advisors are not able to give that kind of money because it goes to the threshold of how much they could give, and there's also the whole rebating clause as well, so it's kind of a gray area. But why the advisor does it is because, one, we've seen they'll usually put a maximum on there, meaning in the fine print it'll say, hey, you can only put up to $10,000 of your money in this 4% because they don't want to be at a lot of money. Some of them I've seen as high as $25,000 you could put in, but there's always a cap. They're not dumb. They're not going to let you put $500,000 of your money at a 4% rate. They're also usually very short term. Watch out for the fine print. It might only be 3 months or 2 months or 1 month. It's not ever going to be a year. In some cases, you might see it at 6 months. So be very, very careful to see all of it in writing. Always ask for everything in writing. And last but not least, why the advisor does this is they're using it as a loss leader. They're hoping to upsell you into some other financial product down the road. Whether it be that they know if you have $10,000, you must have other money somewhere else. Or also, once that $10,000 or $25,000, whatever you end up investing into this, short-term CD at a high interest rate, whenever that does renew and become due to take the money out, they're obviously going to try to tell you to put it somewhere else where they can make money. So it's just like cell phones. I got a free cell phone from AT&T, and I know, of course, they had to pay some money to Apple to give me that free cell phone. And of course, they make money on the long run because I had to sign a 2-year contract. So it's just a loss leader, just like anything. There's nothing real shady about it, except the fact you just want to watch the fine print, and also ask the bank, find out what bank they teamed up with, and just make sure that everything is FDIC insured before you do anything. This is not something you want to rush into. Make sure it is legit. Make sure the person is actually going to pay you. See if you can get it up front, or whatever kind of rules govern that contract you're signing. Make sure you know every single one of them before you ever get any kind of really high rate of return that just doesn't sound exactly right. But that's how they're doing it. They're basically coming out of pocket to pay for you. For more on this and everything about retirement, check out retirementthinktank.com.